Stocks are kind of all over the place here.
The Federal Reserve will raise the federal funds rate by 0.75 of a percentage point today.
Well, the U.S. market fell 2.5% and NASDAQ almost 3.5%.
Yeah, regulators are trying to bring down the worst inflation that we've seen in 40 years.
In less than 10 minutes, you are going to know more about the FOMC interest rate decision last week than almost anyone else on the planet. You'll also know better than any retail trader out there how to approach future rate decisions going forward. I can say that confidently as I worked in investment banking for many years, and it's that perspective you're about to see and learn how to apply in your own trading in this video. Now, last week, the FOMC raised interest rates to 4%. You may have already been aware of this, but more than likely, be honest, you skimmed over this news quickly and carried on with your trading. Big mistake. This decision is likely to influence the market for weeks, if not months to come. So if you are a trader and you do not understand the impact the decision had on the market you are trading, you are putting yourself at a massive disadvantage in what is already a difficult enough business to succeed in. But anyway, fear not, that is what this video is here for today. So what happened last week? Well, the FOMC, the committee responsible for setting US interest rates, met to determine the federal funds rate, and as expected, they raised short-term interest rates by 0.75% to 4%. That was the fourth 0.75% or 75 basis points increase in a row, a record move in interest rates when considering how quickly it's been done. Virtually 0% to 4% in the space of 8 months. That means interest rates at 4% are now at their highest in over a decade. So how did markets react to the decision and subsequent statement, and why does it matter for your trading going forward? Well, the stock market initially rose on the news but quickly sold off heavily straight after. Now, before we get into the specifics of why that happened, it's important to point out using hard evidence that it doesn't matter which market you trade because all markets were impacted in a similar fashion. So if you understand the broader picture, you'll have an excellent handle on how it impacted your market, even if that isn't equities. To prove that to ourselves, let's look at a chart of equities versus other markets. We can see straight away how closely correlated markets are and how they moved almost one for one in lockstep in and around the decision last Wednesday. Here you can see Bitcoin, crude oil, equities, and pound yen. We also have the 2-year treasury rate. So every market covered, and you can see how closely they all move together for yourself. So you can see no matter what you trade, you need to understand these rate decisions in detail. Now, as I just said, the most important thing for your trading is that you A, understand the decision and the statement released just after, but more importantly, B, how the market reacted in the aftermath, because that sentiment is likely to stick around until the next meeting in a few weeks' time, so it will impact your trading going forward. Now, if we want to be successful as traders, we need to start thinking like professional traders. And the most alarming thing for institutional traders right now is just how quickly the Fed has moved in increasing interest rates. In January, rates sat just above 0%, but in record time, the Fed has moved the rate to a 4% target rate. That's a massive move in such a short space of time. So why have they moved so quickly, almost as fast as an Olympic sprinter? Well, when they first started raising rates in January, CPI inflation was at 8.6% year on year, well above the Fed's own 2% long-term target. So they were already well behind where they wanted price inflation to be. They've been playing catch up ever since, right? Why they waited so long to react is a story for another day, but the point is they started so late in the day that they've been playing catch up ever since. Now, even though inflation has been leveling off, it is not coming down, and that is worrying for markets and therefore professional traders, because it means more rate hikes to come. Now, we will talk about the market reaction to last week's decision. However, more important is the likely impact of Fed policy on markets going forward, because that is ultimately what you and I will be trading. Now, to answer that, we need to consider A, how much further will the Fed raise interest rates? B, how quickly? And C, how long will they stay there? As a trader, you absolutely have to have a view on these things. The problem right now for institutional traders such as myself, and one of the reasons we are seeing such a big sell-off and uncertainty in the markets, is because the Fed itself doesn't have an answer to those questions. As I mentioned earlier, they started raising rates way too late when inflation was already above 8% and are now playing catch up. But more importantly, by their own admission, they don't quite understand the lagging effect of all the rate hikes they've been making up until now on the economy. Now, what do I mean by the lagging effect? Well, the FOMC is raising interest rates so they can bring inflation down, right? But the impact of raising interest rates can take time to feed through. It's not instant. That's what I mean by lag or lagging, and it can make it difficult for the FOMC to know what impact raising rates is having on inflation and the economy as quickly as they would like. Now, this is important for your trading because this mention of the word lag was the biggest change in the FOMC statement last week, and initially the market rallied as it perceived the inclusion of this word lag to be bullish or positive. Now let's look at why the market perceived that word to be bullish, because it is extremely important for you to understand. Now I know this is not the most exciting thing to look at in trading, but if it doesn't excite you, then you have to ask yourself, how badly do you want to be in this business? And if you're serious about it, as I will show you, FOMC Chairman Jerome Powell single-handedly drove the market simply by the words that came out of his mouth after the statement was released. So if you don't understand the statement or the subsequent Q&A, immediately stop trading and get up to speed on it. Now don't worry if you don't understand it, because we are going to do that together now. So you can see the statement side by side here. On the right hand side is the statement from the old September meeting, and the left hand side has the statement from last week's meeting. Now the only bit you need to worry about is the extra paragraph they put in. Everything else remained the same. So what was the extra paragraph? Well, let's read it together. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Now, the markets perceive that as positive because if the Fed thinks there may be some lag effects of raising interest rates, i.e. they think that rate increases may not feed through straight away, they may want to pause to see what happens and therefore not raise rates as much going forward. And therefore, ultimately, the peak in interest rates may finally be in sight. A positive thing, right? Remember earlier, I said the number one question on institutional traders' minds is how far will interest rate rises go? What is the peak? So because of the wording of the statement, the market assumed the Fed was signaling they may be about to pause or the end may be in sight. As it turned out, the market completely misinterpreted it, and I suspect what happened is FOMC Chairman Powell caught wind of this initial positive reaction and quickly shut it down in the Q&A that followed, as he went on to deliver some very aggressive statements, literally moving the markets with his words. So when journalists were asking him certain questions, he made it very clear that any talk of pausing the rate hiking cycle was very premature and not realistic. He also made it clear the peak in interest rates is higher than what was outlined in the last meeting. Now we can see here how the Fed's own expectations for where it is ultimately taking interest rates is shifting constantly. They don't know themselves, and that's a big problem. In March, the FOMC was expecting to raise rates to just below 3%. Then in June, they thought it would be just under 4%. Then in the last meeting, just under 5%. The likelihood, by Chairman Powell's own admission, is that rates will now go above 5% before leveling off and potentially coming down from there. So that's another at least 125 basis points or 1.25% higher than where we are now. So can you see why the market quickly sold off as Chairman Powell made these admissions? It became clear to the market that there won't be a pause in rate hikes. In fact, there are potentially several more to come. So to summarize, even though the market rallied at first, we can see here that in fact, it ended up being the worst Fed day performance in January 2021 as the market sold off aggressively after the aforementioned Q&A. So hopefully you can see why it's so important to understand how the FOMC is positioning itself in terms of monetary policy, as ultimately that is what will determine market direction. Now, in my own personal trading, I also sold the markets throughout the week. As you can see here, I sold on Tuesday, Thursday and Friday for some moderate gains. To see more about the way I trade, completely the opposite to retail trading, you can check out my other videos at the end. For now, I want to focus on the decision and how it may impact markets going forward. As we already said, that is ultimately what we are going to be trading. So back to the point at hand, the market's had a big sell-off, so we should expect more bearishness and selling going forward, right? Wrong. Now, I cannot stress how important it is to develop your own opinion and not just go with the crowd. If we look more closely, yes, things have been very bearish this year. We're off over 20% in equities. However, the market is extremely forward-looking. So don't forget, with the most recent sell-off, the market is now already pricing in another 125 basis points of hikes to come. And I would therefore argue a lot of these rate hikes we expect in the coming FOMC meetings have already been accounted for by financial markets, be it in crypto, Forex, or equities, or even commodities. All the markets have sold off for the reasons already outlined. So things would have to get considerably worse for an even further sell-off. Secondly, for the first time at this press conference, whilst the Fed chairman went out of his way to make it clear they will not hesitate to stay aggressive to combat inflation, for the first time he was also willing to talk about where the peak might be. In his own words, as you saw, they are clearly concerned about the lag impacts of rate rises, and the Fed seemed to be comfortable with the market pricing in a peak in rates of about 5.25%. We are already 75 to 80% of the way there. We're at 4% right now, we're trying to get to 5.25%, and the market has already priced most of that in. So realistically, how much further can the market sell off given so much of the bad news is already priced in? This suggests to me that the market may actually start finding some support, maybe not immediately, but in the coming weeks, and the retail crowd will find themselves stuck in short positions or playing bad news as the institutions start to do the opposite and build up long positions, betting on a peak in rates already being priced in. Now, why would institutions want to start building longs? Well, if we look historically at returns after the last rate hike in a cycle, in this case we're assuming just above 5%, we can see that after the peak in rates, the market exhibits very strong returns. Big players will be well aware of this, and with the end of rate hikes likely just a few months away now, I think people will start building positions into that thesis ahead of time. Of course, things can change in a flash, and all of this is data dependent, but I cannot stress the importance of having a baseline scenario from which to trade from and adjusting from there. Be honest with yourself. Do you have a baseline scenario for how much further rate hikes will go, how quickly and how long they will stay there? If not, you need to question why not, because all professional traders will be having a scenario in mind. Now, nothing to worry about if you haven't, as I have shown you my thoughts and my scenario and hopefully fulfilled my promise of getting you to a place where you understand the most recent interest rate announcement better than most traders in the world. So you can now start building your own base case scenario and start thinking like a professional trader. Now, it's great you can finally do that, but to learn more about how to get more granular and actually trade these ideas, watch this video here, which will show you live trades I have taken using institutional methods I learned when I worked in the industry. Have a great week.